Good evening to you all. While we are talking about future, I think one very interesting news doing rounds. I don't know how many of you got this, which has got a major bearing on the Indian economy. News is about there's a possible oil discovery in Andaman Sea. Have you heard that news? Read? Right? So, if right now topic here is 10 trillion economy, if that discovery was to get established, I think this topic will become irrelevant, because Mr. Hardeep Puri has been on record saying that if that discovery is proven, then Indian economy will be 20 trillion economy. And that's where situation is. And there are some few facts which I thought I'll just share with you. I just noted down from the news article. So currently we import about 232 million ton of crude. And the oil find, which is estimated to be 12 billion barrel. So huge discovery. And in value terms, if you have to look at it, currently we import about 132 billion worth of crude every year. Now can you imagine if we have more than 50 years of oil found, that at current levels 132 billion every year saved, and not fully saved because obviously there will be some exploration cost, but then huge money saving, and that's what will get added to Indian economy. That's a kind of impact it will have on our country. Coming back to the topic, while till the time it's not confirmed, it's just news item, so we'll not speculate much on that. So today we know the situation which we are in. First, let's have a look at global economy. All of us know the way situation is, be it geopolitical situation, pandemic situation, again coming up, war-like situation. We earlier saw, Israel, Hamas, Philippines, and then we saw, prior to that we saw Ukraine, Russia, which is now very old news, sort of, almost 3 years. Then we ourselves found, in a controversy with our neighbors, with Pakistan, obviously off and on with China, geopolitical situation getting impacted. And then also we recently saw that again, Israel and Iran coming head on, and which currently situation is becoming bad to worse. I mean, that's a backdrop of global situation, and not to forget about Uncle Trump. And he has his own way of doing business, which has impact on global situation turning opposite. Where sourcing, earlier we used to talk about global village. Now people are focusing on country-specific things, how things need to be imported. So that's a backdrop of economy on the global front. Coming to India, I think situations very different. We are looking at very optimistically. While we spoke about 20 trillion, let's talk about what is already on the record. India is looking at becoming a manufacturing hub. Economy growing fastest, currently 4th largest, trying to become 7 trillion by 2030 and 10 trillion by 2032 through various measures which government has enabled. So in that backdrop, all our CFOs in the background, they are working with various disruptions. Apart from global and country level disruptions, we have our own competition, our own changes, digitalization, regulatory frame change work. All of these are creating, I'm sure, challenge for businesses. Given that scenario, still CFOs have to deliver, not only on a yearly basis, but also quarterly numbers. Many of them, when they are listed, they have to publish. Now, in this battle of currently situation is war, so let's talk about battle. So in this battle, our commanders, how they are working on. So we thought, let's deliberate here and see what strategy of their winning of battle they are deploying in their organizations, so that not only their organization grows, but also Indian economy also grows. So with that, I think panel has already been introduced, so I would ask them to respond to how they are handling various situations. So turning to, Satish. First, Satish, amid persistent inflation and interest rate volatility, what new modeling approaches are CFOs adopting to safeguard margins, maintain liquidity, and plan for different economic scenario?
So as you said that amidst the global turmoil that we have been witnessing for almost more than 1 or 2 years, and if you see how the Indian economy has been performing for the last 1.5 to 2 years, I believe that the only bright spot that we see across the global economy is the Indian economy, which even today is pivoting towards 6.5, 6.7 kind of a growth, which probably is the highest in the world. And if the Indian economy is aspiring to go towards a 10 trillion economy or a 20 trillion economy, it is very important that financing is a very backbone of any kind of an economy, and banking sector, financial services sector plays a very important role. I would say the banking and financial services sector will be the backbone of this entire economic growth. If we see today from an external perspective, if you see one can see that there are too many banks in India. There are large private sector banks, there are large public sector banks, there are small private sector banks, there are small finance banks and all that. But frankly, if you look at a little broader picture for next, say, 15 to 20 years, probably India will require much more banks than what it is there, and much more larger banks to fund this kind of a growth. Now, coming back domestically in terms of what is the impact that banks have been seeing for the last 1.5 to 2 years, based on one, the domestic factors as well as what's happening in the global economy. What we have seen is for the last almost 12 to 13 months or more than that, we have seen severe liquidity crunch in the Indian economy, and that has resulted into increased cost of funding for the banks. The cost of funds has increased, the deposit growth has been muted, and within that, the current account, savings account growth has been decelerating for a long period of time. And largely because overall there was a deficit, liquidity deficit across the economy. However, if you see today, just a couple of weeks back, if you notice that the scenario currently is changing, and changing for good. We have seen successive interest rate cuts. First by 25 basis point cut in repo rate in February, then another 25 basis point cut in June, and very recently a very substantial, much more than expectation by any economist, the Reserve Bank of India cut the repo rate by 50 basis points. Along with that, they have taken multiple measures to improve the overall liquidity situation in the country. And that's the reason that suddenly now we are into a liquidity surplus compared to a liquidity deficit in the economy. In addition to what was expected in terms of the repo rate cut, the Reserve Bank also announced a cut in the CRR ratio, which is a very major kind of a move starting from September, where 100 basis point cut in the CRR ratio will happen. That will provide further growth impetus to the economy. Banks will be left with a large amount of funds for lending. However, we should understand that what impact it had over a period of last 15, 16 months, that the cost of funding of the banks has increased, and a large portion of the funding, if you see, has been through not only by the deposits, but through the borrowings route, and borrowings is always a wholesale funding. So overall, the cost of funds of the banks has increased. And when the cost of fund of the banks increase, it is generally a sticky cost. And it will take about 2.5 quarters for really the impact to percolate down in terms of the cost of fund for the banking. However, the changes in the interest rate, and most of our retail loans in the banking sector, almost 30 to 40% of the advances are linked to externally benchmarked rates. So that is like repo rate. So almost 30 to 40% of the advances will get repriced quite immediately, or maybe in a quarter or so. However, the cost of funds, as I said, will be sticky. So we believe that for next 2 to 3 quarters, there will be squeeze in the margins. If we see what was the profitability trajectory of the Indian banking sector, we have seen a decelerating profitability trajectory over the last 2 to 3 years. the profit growth, which was in the range of 25% to 30% in the banking sector in 2023, decelerated to around 16%, and even 25-26, analysts expect that the profit growth is going to be around 6% or 7%. So in the immediate term, there will be stress on the margins of the bank. There will be stress on the profitability. However, going forward from Q3 and Q4 onwards, we see that this scenario changing for banks, where the impact of lower cost of funds will start flowing into the cost of funds, and that will enable banks to lend better and lend profitably, I would say. So I would say that in sum and substance, the pain in the banking sector, probably we are seeing an end of it over a period of time. Last 7-8 quarters, we have seen that the pain on the NPAs to a large extent has subsided. There is still a residual pain, especially in the, I would say, the microfinance sector or the personal, I would say, the unsecured lending. However, that will not have a very significant impact in terms of the bank's balance sheet. So I would say that it is kind of a 2 quarters kind of a pain in the banking sector, and thereafter the banking sector should be doing pretty well.
Thanks, Satish. I think your words will be music to the ears of many CFOs sitting here, those who want to borrow money and invest, right? So, coming to you, Jitesh, we talk about deglobalization because of various tariffs being, put in by various countries, and more especially our US friend. In that scenario, can you share a recent example where your team identified and acted upon a growth of investment opportunity amid macroeconomic fragmentation and the broader trend of deglobalization?
Okay, so what we do normally is we support pharma and biopharma industry. We also do a lot of industrial products supply in the economy. So one of the focus areas in India was monitoring of pollution. So there are air monitoring systems which are done. Broadly, these systems were imported by India through China, and largely sold to pollution control boards or state governments. Now, the quality of local suppliers was not so great, and accordingly, either the quality installed at centers were low, or probably the cost of an imported equipment was high. We identified this opportunity while the government was trying to incentivize Make in India. We capitalized on that, and we set up a manufacturing setup in Chakan. What we do currently is we are a class 1 supplier now. We do that majorly in India, and we plan to increase our share of components assembled or manufactured in India. And at the same point of time, we have even established suppliers in this downstream process which can be integrated, and hopefully the quality of these air monitoring systems and the price can be matched to the pollution control board's expectation. Generally, these air quality monitoring systems are not only done for government, but for private sector, for whether it is cement, steel, or any other industry, there are requirements where you need to install that. So largely the reliance was reduced outside India, but at the same point of time, the contribution to the Indian economy was in terms of quality and price.
So that's a great example of Make in India or China plus one, so to say. So since we are talking about manufacturing, let's continue with you on our next question, which is how are CFOs capitalizing on India's manufacturing revival, a PLI scheme, and recent policy reforms to drive capital allocation, enhance supply chain resilience, and boost competitiveness?
So I actually want to extend an example. The interaction with state governments or central governments are at a very, very different footings. We are in discussion with 3 state governments, and each of the state government wants us to invest in their, I would say, state, giving the maximum incentive they would like us to invest. For example, we are trying to build antibodies. These antibodies are used in testing of a drug. Mostly these antibodies are imported from China or US. Now when we are planning to expand this capacity in India, each state government is trying to incentivize us because this will be a huge R&D capability set up in India. Similarly, on semiconductor and clean energy. There is a lot of investments flowing in the country, but those are fab manufacturing setups. In order to test a fab, there are certain equipments which are largely imported from outside. So the government is incentivizing the upstream and the downstream processes also to do manufacturing setups in India. So Aneel, I was very, very surprised with the business-oriented mindset by a government officer or a government, state government, to say that this capability building in India will not only do jobs, but it will also upscale the quality of talent which is available, upscale the quality of manufacturing which is available. So we are not only de-risking Taiwan or Korea dependence on semiconductor clean energy, but we are trying to also build a greater amount of talent here. So the investments offered by government are really, really substantial and are really, really exciting for a conversation.
Super, thanks for that. So we all know there's a tension in the air because of war, because of various situations, and CFOs are handling unprecedented situations currently, where I keep saying that now CFOs need to get comfort in discomfort, meaning there's always discomfort. Something or the other is happening. It's no more situation which happens once in a while. It's almost every day there is some disruption or the other. If not, regulatory change will happen. Something force majeure will happen. So there's always disruption, and which leads to tension. And turning that to Nithya on that. So Nithya, how do you manage the tension between delivering short-term returns and committing to long-term investments in areas like renewable, digital infrastructure or advanced manufacturing, especially in aligned with India's strategic growth agenda?
Thank you, Anil. I think it's an age-old dilemma, the balance, striking the right balance between short-term and the long-term. But I do believe the question is more relevant now, especially because in the context of India now trying to become a $10 trillion economy, you're now investing in projects that are no longer incrementally innovative, right? You're really talking about transformative innovation. You're talking about first in India, first in world kind of innovation. So these kind of innovations are obviously risky. They carry a very long gestation period, which is why now it's even more important to be able to balance the short term and the long term. And I think the way to spread the risk, right? It always carries a risk because there is a big reward at the end of it. The way to spread the risk would be, go after proof of concept before you're willing to scale up and make more investments. Stage gate your investments. So there are some few things that we could potentially do to be able to manage the risk better. But that being said, I think you always need a healthy pipeline of both short-term investments as well as long-term. You need the short-term investments, you need those quick wins, one, to be able to demonstrate your capability, and two, to be able to generate the cash that's required to fund your long-term investments. And I would also say that let's not underestimate the sophistication of our public market and private market investors. I think they've genuinely matured in terms of their ability to be able to see the vision and see the reward at the end of the pot at the end of the tunnel. And I think as long as we are able to articulate the vision, articulate the risk and the reward that you're looking at, I think investors will be more than happy to support these long-term projects as well.
Thank you. I think when there's a word called tension, there's always underlying factor is the risk management, isn't it? So
I call it friction. I call it friction, and it's good friction, right? This is friction you want.
That's right, absolutely. Thank you, Nithya, on that. So India is also known as a startup capital, and we'll be now talking to Rohit on a startup. So Rohit, over to you. Startups have been a new growth driver for the Indian economy. How are the startup CFOs are playing their role in building a scale, governance, and investor trust?
No, thanks, Anil. I'll probably start with some data points because a lot of people still think that startup is like a very niche thing. As per NASSCOM estimates, by 2030, startups would contribute almost 5% to India's GDP, right? Startups already are generating almost 5 million plus jobs. I'm counting both direct and indirect, right? So the impact which startups can create and the value which startups can add to the overall GDP is like proven by numbers now, right? I would say that, and specifically coming to the role of CFOs for startups, what has happened in the last, I would say, 3-4 years, has been a complete transformation of how startups have been operating, right? So while my friend Satish mentioned about margin profile changing a bit, for startups it has been a world of moving from negative losses to becoming profitable, right? Which has been a complete new world for a lot of them, right? And again, you would be reading in the press, a lot of startups have actually successfully done that pivot, right? I would believe that for most of them, the role played by the CFO has been one of the most important ones, right? Because coming from a state where nobody bothered about unit economics to actually figuring out the right economics, gross margin profile, and ultimately, to EBITDA. That is a journey which clearly a CFO can understand and then articulate to the team, right? Goes all the way down to framing the right KPIs, because ultimately once the team delivers that is when you move towards profitability, right? So clearly I would say that for startups specifically, the role of CFO has become very, very important in this journey towards profitability. I would also say that the corporate development role in the startups, invariably the CFO becomes the right person for that. Be it inorganic options, be it various partnership opportunities. And I mean, again, coming from a very personal experience at GOQii, we started our UK and Saudi business in partnerships. So for instance, in the UK, we collaborated with one of the largest GP chains there. In Saudi, we partnered with the largest health insurance company there, right? So the importance of such partnerships becomes very, very important for startups who work on a lean team, lesser resources, I would say, compared to large organizations, but still have to deliver results, right? And I think the CFO, again, the CFO role fits in really, really well to understand how this can actually work on a numbers perspective. And again, just one data point specifically on the governance side. I mean, unfortunately, there've been some bad examples of startups. So the magnifying lens on startups becomes even more bigger, so to say. But I was reading somewhere that if you compare the bad startups, so where there's been some kind of wrongdoing, right? That percent in China obviously is much higher. India is lower than China, and we are kind of there compared to USA, right? See, ideally speaking, it should be zero. No, there should not be any wrongdoing, right? But if you look, so I would actually again think of Indian startups and CFOs doing a good job there, being kind of near to USA, right? So I would say yes. I think in all these things, if you were to analyze, I think the CFO role becomes really important.
Thank you, Rohit. And when you talk about a startup, obviously, apart from revenue profitability, what comes in mind is the capital, right? And who else can answer a question on capital other than the banker? So Satish, coming to you. So what strategies are you using to future-proof your capital structure and funding approach, especially in light of tightening global credit conditions and shifting investor expectations?
So one thing which is very important to understand is that bank as an entity is the most regulated entity. And like Aneel was mentioning that there is never a normal time, because something or other will always be changing, and that will impacting the performance of any bank. So if you look at it, especially for a listed entity and listed bank, there are too many balls in the air that CFOs has to manage. One, banking is an entity where for a growth you will require capital continuously, because of course there is a concept of capital adequacy ratio and that has to be maintained. So if you grow, then you need to raise capital from the market from time to time. At the same time, there are multiple things to be managed, especially from an investor's perspective. Margin is a very simple word, but there are 5-6 things which impact the margins. One thing which I talked about is in terms of what is the customer interest rates and that impact based on the external benchmark, it will keep on going up and down. The second is the cost of fund. Cost of fund has an impact based on what is your current account savings account ratio, what is the cost of funds, what is the cost of deposits, and that has an impact in terms of your overall funding cost. That has overall impact on the margins. The next comes in terms is your cost income ratio, and there are multiple vectors in that. For banks, 3 or 4 major aspects which impact the cost income ratio. The biggest cost is the people cost, contributing almost 50% of the overall cost. And banks have to ensure that this cost is optimized very well in terms of how to ensure that the productivity is taken care of, at the same time increasing the workforce in the bank. Second is in the technology cost, and that is an ever increasing kind of a cost, and most of the banks will be spending almost 8 to 10% of your OPEX in technology cost. A lot of that OPEX is not only just to run the bank, but also to grow the bank. And also there will be cost which will be incurred due to meet the regulatory requirements. The next is the distribution cost. Distribution cost is again an ever increasing cost. Most of the banks are expanding. Though we have a digital world today where most of the transactions are done digitally, however, for acquiring customers and all that, we still require a physical branch presence, and that requires a humongous amount of investments. If all these things we are able to manage, the ultimate truth for any bank is in terms of the return on assets and return on equity, and that ultimately boils down to the profit that we make. So apart from your interest income, the other component is the fee income, which again is very tough in the competitive world, as to ensure that how to generate fee income, and that too a reasonable fee income to the average assets of the bank. And then of course what equity you require. So if you raise too much of a capital, growth capital, then that has a directly impact on the return on equity. So I can keep on talking in terms of what all things as a CFO one needs to manage. It's a very fine balance, and I would say that bankers who are able to manage that, they get rewarded by the market. So there is no one perfect answer in terms of how to manage the profitability, I would say.
Thanks, Satish, for your insight on this. A round of applause for the panelists.